Las Vegas leads the nation in homes nobody wants to buy. Its for-sale inventory has exploded nearly 45% in a single year. In the past, sellers could expect a steady stream of offers within days. Now, weeks may pass with little more than questions about incentives or price reductions. The metric known as days on market, often shortened to DOM, has become a key signal for both buyers and sellers. During the pandemic boom, buyers raced to lock in deals, pushing DOM to historic lows. But as mortgage rates rose and demand faded, homes began to accumulate on the market. A property that does not sell quickly often becomes less attractive, prompting further delays as buyers wonder what is wrong or hold out for a better deal. This drop in sales volume is one of the clearest signs that demand has thinned out, leaving more homes unsold at every price point. The median sale price in July was $440,000. A 2.2% decrease from a year earlier, and now slightly below the national median of $443,471. The retreat is visible across the buying spectrum. Investors who once drove up prices with cash offers and quick closings are pulling back. Many have already listed properties acquired during the pandemic boom, hoping to exit before values slide further. Everyday buyers, including first-time homeowners and retirees, are also stepping away. Rising mortgage rates, hovering near 7%, have pushed monthly payments out of reach for many, while economic uncertainty has made others hesitant to commit. Some retirees who moved to Las Vegas during the pandemic are now selling and leaving, citing higher living costs and a fading sense of security as tourism and local job markets soften. The result is a shrinking pool of buyers confronting a growing supply of homes. Sellers who refuse to lower their prices are often left waiting, while those who do cut prices or offer incentives are finding that even these measures do not guarantee a quick sale. The average home now sells for less than it did a year ago, and with fewer buyers in the market, the downward pressure on prices is likely to persist. Redfin's data shows that the slowdown is not isolated to one part of the city or one type of home. From suburban subdivisions to downtown condos, the pattern is the same: fewer closings, softer prices, and a sense of caution that pervades every negotiation. As investors and retirees exit, and everyday buyers hesitate, Las Vegas faces a market where supply keeps rising, but demand continues to slip. This data is from Redfin. In the wake of record demand, Las Vegas homebuilders moved at a pace the city had not seen in decades. Clark County issued more than 16,800 single-family permits and over 7,200 multifamily permits in 2021, both all-time highs. The surge continued into 2022, with more than 15,000 single-family permits still flooding through, even as market signals began to flash warnings. Developers raced to break ground on new subdivisions across Summerlin, Henderson, and the Southwest Valley, convinced that the migration boom and investor appetite would last. Internal builder memos from that period reveal a clear strategy: capture as much of the demand as possible, even if it meant outpacing the city's historical absorption rates. Daryl Fairweather, chief economist at Redfin, said Las Vegas experienced one of the largest construction booms during the pandemic. That supply is still coming online, even as buyers have pulled back dramatically. Builders, buoyed by low interest rates and headlines about out-of-state buyers, kept pushing projects through city council and planning commission meetings. Staff cautioned about the risk of oversupply, but those concerns were often dismissed as temporary and tied to pandemic anomalies. As the pipeline swelled, the median sale price in Las Vegas shot up from under $300,000 in 2019 to a peak of nearly $447,500 by June 2022. Affordability has become the central barrier for both residents and newcomers. As mortgage costs climb, buyers are forced to recalculate what they can afford, often stepping back from the market entirely. Some who moved to Las Vegas for its reputation as an affordable haven now find themselves priced out by the very city they chose. The result is a growing inventory of homes with fewer qualified buyers willing or able to make offers. Supply pressure. The city's economic backbone, tourism, has also weakened, compounding the problem. The Las Vegas Convention and Visitors Authority reported an 11.3% decline in visitor volume in June compared to the previous year. Convention attendance fell 10.7% and hotel occupancy dropped 6.6%. These figures are not just statistics. They represent thousands of jobs and billions in local spending. According to the Nevada Gaming Control Board, net income on the Strip plunged 40.4% in the 2024 fiscal year, with overall gaming income across Nevada down 24.4%. Fewer visitors mean fewer shifts for hospitality workers, smaller tips for service staff, and less disposable income circulating through the city's neighborhoods. Tourism. A spokesperson for the Las Vegas Convention and Visitors Authority pointed to economic uncertainty as a key factor behind the tourism slump. National headlines about inflation and recession risk have made travelers cautious, while companies scale back on conventions and corporate events. An analyst from the Nevada Gaming Control Board described the impact as a feedback loop. When the Strip suffers, so does the rest of the city. Layoffs or reduced hours in hospitality ripple outward, shrinking the pool of qualified home buyers and stalling demand for both rentals and purchases. Feedback loop. The combination of high mortgage rates and shrinking tourism leaves Las Vegas at a crossroads. Homeowners looking to sell face a market with more supply and fewer buyers, while those hoping to buy must contend with steeper costs and uncertain job prospects. For now, the city's housing market remains stuck in a holding pattern, shaped as much by global finance as by the fortunes of the Strip. Holding pattern data from Freddie Mac, the Las Vegas Convention and Visitors Authority, and the Nevada Gaming Control Board. At the top of the Las Vegas market, luxury homes are now piling up faster than agents can move them. According to Realtor.com, listings priced at $1 million or more reached 1,188 in July, a 42% jump from the previous year. This is the largest increase among major U.S. metros, and it stands in stark contrast to the national pace, where million-dollar listings rose just 21% during the same period. The glut is not just about volume, it is about price. Sellers are slashing asking prices to attract buyers who have grown cautious or are simply looking elsewhere. In the $1.2 million and up range, average sale prices dropped by more than 12% year over year in July. For homes listed at $2 million or more, the cuts are even deeper, with prices falling 18.3% compared to last year. Anthony Smith, senior economist at Realtor.com, points out that Las Vegas's luxury segment has become a case study in oversupply. He says million-dollar-plus listings have outpaced national trends, and even with deep price cuts, buyer demand simply is not there right now. Many of these homes were built or flipped during the pandemic boom, when out-of-state buyers and investors were eager to secure a slice of the city's high-end real estate. Now those same properties are sitting empty, staged for endless showings or quietly withdrawn from the market after months without offers. A local luxury agent describes the current environment as a waiting game. Sellers who once expected bidding wars are now fielding low-ball offers or watching as would-be buyers take their time, comparing options across dozens of similar homes. The surge in inventory has shifted leverage decisively toward buyers, granting them more room to negotiate and little urgency to close deals. Many buyers are requesting significant concessions, upgrades, closing cost credits, or even interest rate buydowns, knowing that sellers are under increasing pressure to make a deal. For the luxury segment, the pandemic's after-effects are especially pronounced. Developers who banked on a steady flow of wealthy newcomers now face months of unsold inventory, and the reality that price cuts alone may not be enough. As Smith notes, the luxury market is saturated, and it is going to take time and further adjustments for the excess to clear. Data from Realtor.com. Tanya Jayam has spent more than 3 decades helping Las Vegas families buy and sell homes, but the past year has challenged even her experience. She describes a market where patience is no longer enough. Sellers who want to move on must offer something extra. Incentives like seller-paid closing costs or interest rate buydowns have become the new norm. Tanya points to recent listings in the MLS where homes lingered for weeks until the seller agreed to cover a portion of the buyer's mortgage rate finally tipping the deal across the finish line. In her words, homes that move now are the ones priced for today's reality, or where sellers help buyers with costs they cannot manage on their own. For some, these measures come too late to avoid losses. The Smith family, longtime residents of Summerlin, bought their home in 2020 for $445,000. When they needed to relocate in 2024, they listed at a hopeful price, only to watch weeks turn into months with little interest. After repeated price cuts and a string of showings, they accepted an offer of $430,000, less than their purchase price. To secure the sale, they agreed to pay a 3% credit toward the buyer's closing costs and helped buy down the buyer's mortgage rate. The Smiths walked away with less than they started. A story echoed in hundreds of MLS records across the valley. Maria, a hotel server and member of Culinary Workers Local 226, once counted on steady shifts and healthy tips to support her family. In 2022, she earned about $3,400 a month. After visitor volumes dropped and hotels cut hours, her monthly income fell below $2,700. She has postponed her dream of homeownership, instead picking up extra evening work and doubling up with roommates to make ends meet. Union records show many hospitality workers facing similar choices: delaying down payments, missing mortgage payments, or leaving the city altogether. The loss of tourism revenue does not just affect casino floors. It ripples out, shrinking the pool of qualified buyers and making it harder for working families to find stability. Agents like Tanya say the path forward depends on how sellers respond. In today's market, homes that sell quickly are those priced aggressively or offering meaningful incentives. Others risk sitting for months, especially if owners refuse to adjust to changing conditions. Buyers have more leverage than at any point in recent memory, negotiating not just on price but on repairs, credits, and even help with interest rates. In this climate, the choices made by individual sellers and workers shape the future of entire neighborhoods. Whether Las Vegas can regain its footing will depend as much on these ground-level decisions as on any headline statistic. Data, MLS, and Culinary Workers, Local 226. Las Vegas now holds more unsold homes than any city in America, a living reminder that even boom towns can stall. As mortgage rates hover near 7% and tourism remains uncertain, sellers and buyers face a standoff with no easy answers. What happens next will shape not just property values, but the city's very sense of promise. In the desert, abundance can become emptiness overnight.